Imagine a future where financial security is within reach and all it takes to start is $100. While the stock market might be volatile, bonds can offer a steady path to financial independence. Bonds are often underestimated, yet they provide stability and predictable income, making them an essential tool in any diversified portfolio. In this video, I'll reveal the top 7 bonds to invest in before the end of 2024. We'll dive deep into why each bond is worth considering, how much you can expect to earn, and why timing is crucial if financial freedom is your goal. Let's start with the backbone of the bond world, U.S. Treasury bonds. These are government-backed securities, meaning they're considered among the safest investments globally. Why invest? Treasury bonds come with virtually zero default risk since they're backed by the U.S. government. Especially in uncertain times, these bonds provide a strong foundation for steady, predictable income. Example, if you invest $100 in a 10-year Treasury bond with a yield of around 4.5%, you'll be looking at approximately $4.50 annually. Over 10 years, this adds up to $45 in interest. Timing benefit. The earlier you buy these bonds, the more you can take advantage of the power of compounding if you reinvest the interest. It's a low-risk way to see steady growth. Next, let's talk about municipal bonds, also known as munis. These bonds are issued by state or local governments to fund public projects like schools or infrastructure improvements. Why invest? The biggest draw of munis is that they're often tax exempt at the federal level and sometimes at the state level, making them particularly attractive if you're in a higher tax bracket. Example, say you invest $100 in a muni bond with a 3% yield. In a tax-free scenario, that 3% effectively translates to a higher pre-tax return compared to many taxable bonds. Impact of early investment. Given the tax savings and compounding potential, investing in munis as soon as possible can help you keep more of your earnings, especially if you're saving for retirement. Corporate bonds are issued by companies needing funds for operations, growth, or development. While they carry higher risk than government bonds, they also typically offer higher yields. Why invest? Corporate bonds can provide returns between 5 to 7%, significantly higher than government bonds, especially if you opt for high-quality bonds issued by large, stable corporations. Example, let's say you purchase a $100 bond from a blue-chip company with a 6% yield. You'd earn $6 annually, which might not sound like much, but it's far more than a savings account. Starting early. The earlier you invest, the more interest you can collect over the bond's life. Starting with corporate bonds in your 20s or 30s means you can accumulate years of interest and reinvestment potential, amplifying your growth toward financial independence. Inflation erodes purchasing power, which is where Treasury inflation-protected securities, TIPS, come in. These U.S. Treasury bonds are designed to protect your investment from inflation by adjusting with the Consumer Price Index, CPI. Why invest? TIPS offer an annual interest payout and a principal adjustment based on inflation rates, providing both security and growth potential in uncertain economic times. Example, if inflation is 3%, the principal of a TIPS bond you bought for $100 will increase by $3, making it worth 103s. This higher principal also means your interest payout increases. Early investment significance. With inflation-adjusted growth, TIPS provide long-term purchasing power. The sooner you invest, the better you can counter inflation's impact over decades. These bonds are issued by companies or governments with high credit ratings, rated BBB or higher by credit rating agencies. They're a step up in yield from treasuries, but with much lower risk than high-yield bonds. Why invest? Investment-grade bonds balance risk and return effectively, making them ideal for steady, secure income without the volatility associated with stocks. Example: a $100 investment in an investment grade bond with a 5% return generates $5 a year. Over 20 years, this grows to $100 in earnings, doubling your initial investment starting early. Investment grade bonds suit both young and mid career investors looking to gradually increase wealth without excessive risk. Holding them long term helps you benefit from both regular income and capital preservation. High yield bonds, often called junk bonds, carry more risk but offer higher returns. They're typically issued by companies with lower credit ratings and are suitable for risk-tolerant investors. Why invest? With yields that can reach 8 to 10%, these bonds offer potentially strong returns, but it's crucial to be selective, focusing on sectors or companies you understand. Example: if you invest $100 in a high-yield bond with a 9% return, that's $9 annually. While the risk is higher, this can be a strategic addition to a diversified portfolio. Importance of early investment. Investing early allows for the chance to capture these high returns over time. Reinvesting these higher yields can supercharge portfolio growth if you have the risk tolerance. Series Y. Savings bonds are U.S. government-backed and designed to help investors protect against inflation, much like TIPS, but accessible with a minimum investment of $20. Why invest? Series Y bonds combine a fixed rate with an inflation rate adjustment every 6 months. The current rates often outpace traditional savings options. Example: if inflation averages 3%, and your fixed rate is 0.5%, your Series Y bond would pay 3.5% annually. This means a $100 bond could yield $3.50 per year, more if inflation rises. Early investment significance. Starting early with I bonds allows you to continuously compound growth, providing an inflation-resistant cushion for your retirement or financial independence goals. Investing in bonds isn't just about seeking safer returns. It's about creating a foundation for your financial future, especially if you start now. By diversifying across these 7 bond types, you're setting yourself up for income stability and growth potential. Remember, even a small initial investment, like $100, can grow over time when managed wisely and compounded. If you're committed to achieving financial independence, bonds offer a pathway that can complement more volatile investments. Thanks for watching, and make sure to check out my other videos to continue building your roadmap to financial freedom.